will come to order. I ask the Capitol Police to please remove anyone in the audience who is interrupting the hearing. Before we proceed, I'll remind my audience that any interruption of the hearing will not be permitted and you will be escorted out of the room. We will now proceed. This hearing is part of the Banking Committee's ongoing oversight of the massive trading loss announced by JPMorgan Chase and the implications for risk management, bank supervision, and the Wall Street Reform Act. Since the announcement of the loss in early May, this committee has heard from the OCC and the Fed, which are the primary regulators for JPMorgan, as well as the FCC, the CFTC, and other relevant officials, to review and learn from these events. Several members of the committee have asked to hear from Mr. Dimon, and after due diligence conducted together by my staff and Ranking Member Shubley's staff, I decided to invite Mr. Dimon. Last week, the regulators informed the committee that there was a breakdown in the risk management involved with these trades, despite the fact that the trades were reportedly designed to reduce the bank's risk. As they continue to look into the matter, officials have assured our committee that the firm's solvency and the stability of our financial system are not in jeopardy at this time. While this is welcome news, questions remain that must be answered if we want our largest bank to better manage their risks to maintain financial stability, as I believe we do. Today marks the 2-month anniversary of Mr. Dimon's Tempest in a Teapot comments, where he downplayed concerns from the initial media reports of the company's chief investment office trades. We later learned, however, was an out-of-control trading strategy with little to no risk controls that cost the company billions of dollars. I've said before, no financial institution is immune from bad judgment. In Mr. Dimon's own words, he later explained, quote, "We made a terrible, egregious mistake. There was almost no excuse for it. We know we were sloppy. We know we were stupid. We know there was bad judgment. In hindsight, we took far too much risk. That strategy we had was badly vetted. It was badly monitored. It should never have happened," unquote. So what went wrong? For a bank renowned for its risk management, where were the risk controls? How can a bank take on far too much risk if the points of trade was to reduce risk in the first place? Or was the goal really to make money? Should any hedge result in billions of dollars of net gains or losses, or should it be focused solely on reducing a bank's risks? As the saying goes, you can't have a cake and eat it too. As for the policy implications, some of my colleagues complained that Wall Street Reform micromanages the operations of a large bank, and the regulators cannot keep up with bank innovation. I disagree with that less supervision and less regulation will magically make the system less risky. While risk cannot be eliminated from our economy, we can and must demand that banks take risk management seriously and maintain strong controls. We must also demand that regulators do their job well. After all, banking is an important but risk-filled business that needs careful scrutiny and oversight so that mismanagement or unsafe and unsound practices do not threaten the stability of our economy. Some also suggest that capital is a silver bullet in financial regulation. While capital does and must play an important role as a backstop, we should not rely only on capital. Any well-capitalized bank can fail and threaten financial stability if it is not well-managed or well-regulated. Our financial system will be safer and stronger with multiple and well-calibrated lines of defense, which Wall Street reform requires in addition to higher capital standards. We need our regulators to finalize these Wall Street reforms, and Congress should fund them with sufficient resources so that they can effectively monitor the financial system. Again, it has been 2 months since he first publicly acknowledged that the trades, so I expect Mr. Dimon to be able to answer tough but fair questions today. A full accounting of these events will help this committee better understand the policy implications for a safer and a stronger financial system going forward. Thank you, Mr. Dimon, for your testimony. As we begin questions, I ask the clerk to put 5 minutes on the clock for each member. Mr. Dimon, there was clearly a breakdown in risk management at your firm. What did you do, when you made your tempest in a teapot comment? Why were you willing to be so definitive a month before publicly announcing the losses when it appears you did not have a full understanding of the trading strategy?
Let me first say, when I made that statement, I was dead wrong. I'd been on the road, I had called Ina Drew, who ran the CIO. I'd spoken to our risk officers, our CFO. They were looking into it. There were some issues with CIO before April 13th, we announced earnings. I was assured by them, and I have the right to rely on them, that they thought this was an isolated, small issue and that it wasn't a big problem. They look at things like how bad can it get? They stress it, and under no event it looked like it would be getting nearly as bad as it got after April 13th.
Mr. Dimon, there were reports that the CAO had scrapped a risk limit that would have required traders to exit positions if losses exceeded $20 million. Is this true? If yes, did you approve this, and why was the limit removed?
There was no loss limit, I know, of $20 billion.
$20 million.
How much?
$20 million.
Billion.
With an M.
No. Million. Million.
Yeah.
No, I'm not unaware of a $20 million loss limit. CIO had its own limits around credit, risk, and exposure. At one point in March, some of those limits were triggered. The CIO at that point did ask the traders to reduce taking risk, and she started to look very heavily into the area, which is the proper thing to do. Sometimes triggers and limits do get hit, and what should happen afterwards is people focus on it, think about it, and decide what to do about it.
There have been concerns raised about the change made in the CIO's risk model. When were regulators notified? Why was the risk model changed? Did this change mask the true risks of the trading activity?
So what I am aware of is that sometime in 2011, the CIO had asked to update their models, partially to get them updated to be compliant with the new Basel rules. Model reviews are done by an independent model review group. They started the process 6 months earlier, and in January they did in fact put in a new model. I should note that models are changed all the time, always being adjusted to try to be better. Inform yourself of the past and try to make models get better. The models were approved by the model review group, were implemented in January, and did effectively increase the amount of risk this unit was able to take. When on April 13th, we were still unaware that the model might have contributed to the problem. So when we found out later on, we went back to the old model. So the old model was more accurate in hindsight than the new model we thought it was going to be.
Reports suggest there are multiple warnings of weak controls at the CAO that were ignored in your testimony states that your treating strategy was not reviewed outside CIO. Did you, Mr. Dimon, make the decision to exempt the CIO from any review of risk controls outside of the unit? Or why was no one watching?
I think the first error we made was that the CIO unit had done so well for so long that I think there was a little bit of complacency about what was taking place there and maybe overconfidence. It did have its own risk committee. That risk committee was supposed to properly overview and vet all the risks. I think that risk committee itself, while independent, wasn't independent-minded enough and should have challenged more frequently and more rigorously this particular synthetic credit portfolio. I think the second related risk is that the synthetic credit portfolio itself always should have had more scrutiny. It was higher risk, it was mark to market, it should have had more scrutiny and different limits right from the start.
Mr. Dimon, did the pay structure for the employees at the CIO incentivize risky behavior that led to the massive trading loss instead of rewarding those who reduced the bank's risks? Were there bonuses for generating profits out of the CIO? Will you seek clawbacks from traders, management, and executives involved in this trading debacle?
So I think, let me just give a big picture about compensation at JPMorgan. To start with, we don't, and have not had for 5 or 6 years, special severance packages for executives, change of control, parachutes. There was no one in CIO who was paid on a formula. The management of the CIO portfolio was subordinated to the rest of the company. They were not allowed to do what they want. They couldn't invest very long. They couldn't take too much high-yield exposure, et cetera. They were paid for what they did for the whole company. And when we pay people, everyone, we look at their performance, the unit's performance, the company's performance, and their performance includes recruiting, training, integrity, sharing with senior management, all the things that we need to do to make it a better company. So I don't believe that the compensation made this problem worse, and like I said, none of these folks were paid on a formula. Oh, your second question was clawbacks. When the board finishes a review, which I think is the appropriate time to actually make those final decisions, I think it would be inappropriate to make those decisions before you finish your final review. You can expect that we'll take proper corrective action, and I would say it's likely, though this is subject to board, but it's likely there'll be clawbacks.